Before you buy a stock, before you buy an ETF, before you listen to that guy on social media who claims he turned $500 into a Lamborghini, you need to understand one of the most important investing tools ever created, the price-to-earnings ratio, or as investors call it, the PE ratio, because apparently saying price-to-earnings ratio repeatedly is considered cardio. Stay until the end because I'll show you what PE ratios can tell you, what they can't tell you, and why a low PE ratio doesn't automatically mean you're getting a bargain. Welcome to Simply Speaking About Money, the channel where we focus on budgeting, saving, and long-term investing using probabilities instead of possibilities. No hype, no get-rich-quick schemes, no magic stock picks from your cousin's neighbor's barber. Just practical investing information explained in plain English. Let's get started. The PE ratio compares a company's stock price to its earnings. That's it. That's the entire concept. Simple enough that Wall Street somehow turned it into an entire industry. Here's the formula. PE ratio equals stock price divided by earnings per share. If a company's stock trades at $100 and earns $5 per share, the PE ratio is 20. 100 divided by 5 equals 20. No calculator panic required. Investors use PE ratios to estimate how expensive or cheap a stock may be. Think of it like shopping. If one coffee maker costs $50 and another costs $500, you naturally ask, what exactly am I getting for 10 times the price? PE ratios ask a similar question about stocks. Imagine two companies. Company A has a PE ratio of 10. Company B has a PE ratio of 30. Investors are paying 3 times more for Company B's earnings. Why? Usually because they expect faster growth, or because everyone got excited, sometimes a little too excited. A high PE ratio often means investors expect strong future growth. They believe earnings will increase significantly. Think of it as paying premium prices today because you expect bigger profits tomorrow. Sometimes that works. Sometimes it resembles paying luxury car prices for a bicycle. A low PE ratio often suggests a stock may be undervalued, but not always. Sometimes a stock is cheap because investors expect problems ahead. A PE ratio is a tool, not a fortune teller. If PE ratios predicted the future perfectly, every investor would be retired on a beach by now. Most aren't. Many are still arguing online. You should never look at a PE ratio by itself. A PE ratio only becomes useful when compared to the company's history, its competitors, its industry, and the overall market. Context matters. Just like a 102-degree temperature means different things, depending on whether we're talking about a human or a desert. Suppose two large banks have similar businesses. One trades at a PE of 10, the other trades at a PE of 20. That difference might deserve investigation. Why is one priced much higher? There may be a good reason, or investors may simply be in a very optimistic mood. Comparing a software company to an electric utility using PE ratios alone is like comparing a racehorse to a lawnmower. Both serve a purpose. Neither belongs in the same race. Many investors compare a company's current PE ratio to its historical average. If a company normally trades around 20 and now trades at 30, investors may be paying a premium. That doesn't automatically mean it's bad. It simply means expectations are higher. So far, we've discussed trailing PE. That's based on past earnings. Forward PE uses projected future earnings. It's essentially Wall Street saying, "Trust us. We think earnings will grow." And sometimes they're right. Trailing PE looks backward. Forward PE looks forward. Most investors consider both. One tells you what happened, the other tells you what people expect to happen. Quick pause. If you're finding this helpful, please hit the like button and subscribe. It helps the channel reach more people who want practical investing education without the drama. Now let's continue. If you feel like your money disappears before the month is over, it's not a math problem, it's a plan problem. That's where YNAB, you need a budget, comes in. YNAB is built on one simple principle. Give every dollar a job before you spend it. Instead of guessing where your money went, you decide where it goes, in advance. It helps you break the paycheck-to-paycheck cycle, build real savings, and finally feel in control of your finances. This isn't about restriction, it's about intention. If you're serious about budgeting the right way, check out the link in the description to try YNAB for yourself. Affiliate disclosure. I may earn a commission if you sign up using my link at no extra cost to you. Let's finish things up. Most ETF providers publish the average PE ratio of their holdings. This gives investors a rough estimate of how expensive or inexpensive the portfolio may be. It's like looking at the average price tag of everything in your shopping cart. Imagine two broad market ETFs. One has a PE ratio of 18, another has a PE ratio of 30. The second ETF contains stocks investors are willing to pay much more for. Growth ETFs frequently have higher PE ratios. Investors expect future earnings growth. The higher PE is essentially the market saying, "We're willing to pay extra today." Value ETFs usually have lower PE ratios. These funds focus on companies trading at lower valuations relative to earnings. Think bargain shopping. Not everything on sale is a good deal, but sometimes it is. Absolutely. Many great companies have traded at high PE ratios for years. Strong growth can justify higher valuations. The key word is can, not will. When PE ratios become extremely high, expectations become enormous. The company doesn't just need good results, it needs spectacular results. Every quarter, forever, no pressure. If earnings disappoint, stocks with high PE ratios can fall quickly. Investors suddenly realize they paid luxury prices. For ordinary results, markets can be surprisingly unforgiving. Low PE ratios can also be dangerous. Sometimes investors are avoiding a stock for good reasons. Declining earnings, weak growth, competitive threats. Not every cheap stock is a hidden treasure. Some are simply discounted problems. PE ratios often rise during bull markets. Investors become optimistic, sometimes extremely optimistic. History shows optimism occasionally gets carried away. Human beings are consistent that way. When investors expect endless growth, PE ratios expand. Stock prices rise faster than earnings. This can create overvaluation risks, and that's exactly what we'll discuss in Part 2. Interest rates influence PE ratios. Lower interest rates often support higher valuations. Higher interest rates frequently put pressure on valuations. Money has a cost, even when investors prefer to ignore that fact. Professional investors rarely rely on PE ratios alone. They also examine revenue growth, debt levels, cash flow, profit margins, competitive advantages, and management quality. Think of PE ratios like a dashboard gauge in your car. Useful? Absolutely. Enough information to drive safely? Not by itself. You still need the rest of the dashboard. One of the biggest beginner mistakes is assuming low PE equals good investment. High PE equals bad investment. Reality is more complicated. Unfortunately, investing rarely fits neatly onto a bumper sticker. Another mistake is ignoring valuation completely. People fall in love with exciting stories. They stop looking at numbers. That's usually where trouble starts. The goal isn't to find the lowest PE ratio. The goal is to understand what you're paying for. Price matters, value matters, and expectations matter. A PE ratio tells you how much investors are paying for a company's earnings. It can help identify potential bargains. It can help identify expensive valuations, but it should never be used alone. Let's summarize. PE ratio equals price divided by earnings. High PE often means high growth expectations. Low PE may indicate value or trouble. Compare companies to their peers, use context, and never depend on a single metric. Thanks for watching. If you learned something today, please like, subscribe, and share the video. And be sure to watch part 2 of this series. Is the market overvalued? Is the market overheated? And what should investors do? We'll look at market valuations, warning signs, historical examples, and practical strategies for long-term investors. Because knowing what a PE ratio means is important. Knowing what it means for the entire market may be even more important. Until next time, remember, budget, save, invest, and invest based on probabilities, not possibilities. If you want to see your entire financial life in one place, clarity is the first step. That's where Empower comes in. Empower gives you powerful tools to track your net worth, monitor investments, analyze fees, and plan for retirement, all in one dashboard. You can connect your accounts, see exactly where you stand, and make smarter decisions with real data, because what gets measured gets managed. If you're serious about organizing your money and building long-term wealth, check out the link in the description to explore Empower. Affiliate disclosure: I may earn a commission if you sign up using my link at no extra cost to you.